This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the PremiereTrade Forex Report with Scott Norse.
Good Friday afternoon, traders. Scott Norse here, wrapping up the week with the Forex Report. Today is January 18th, 2008. Well, today was really no different than the rest of the week, as a number of issues and concerns continue to play tug-of-war with currencies. University of Michigan Sentiment, today's only economic report, surprised to the upside with a 5-point jump. It was a good week for the dollar overall when we compare it to recent history. The greenback performed especially well against the New Zealand dollar, which fell victim to unwinding carry trades. The Aussie was also on the weak side, but has found better support on the back of strong fundamentals and a hawkish RBA. The pound was rebounding well early on, but got crushed this morning with the worst retail sales in 11 months out of the UK. The Canadian dollar fought back a little today after several consecutive weeks of declines. Of course, the yen has been the real winner in recent weeks as traders continue to run from risk. The Asian currency flexed its muscles again this week as investors continue to pay back loans in Japan that were used to fund high-yielding trades. These carry trades have really held a strong correlation to stocks this month, and we continue to rely on this relationship for confirmation. Now to the big picture. The big picture may become clear in the near future as the Federal Reserve and U.S. government team up to fight off a recession. Ben Bernanke said yesterday that rate cuts alone will not be enough and the job should not be left entirely to the Fed. One problem with simply cutting rates is the 6 to 9 month lag time before the economy truly reaps the benefits. The consumer already feels beat up, and only government intervention can ease that pain right now. Bush today called for direct and rapid tax relief for individuals and businesses to help stimulate the economy. The president says the plan will total about $150 billion, or 1% of GDP. He added that this is the country's top priority and must happen as soon as possible. Thus far, investors do not seem overly impressed, although stocks recovered briefly when Hank Paulson later spoke on the matter. The stock market is certainly a primary concern at this point. Major indexes such as the Dow and S&P should let us know in the next month or so whether investors gain confidence in the joint efforts being made. Right now, stocks are on a slippery slope, and ironically, this is helping the dollar. Investors globally are dumping stocks and pouring money into U.S. Treasury notes. Furthermore, risk aversion is hurting high-yielding currencies that are still backed by strong fundamentals because traders would now rather be safe than sorry. More so than the dollar, the yen is really getting a boost in this theme. Of course, even if we do avoid a recession, and we hope that's the case, it will not likely be a great year for the greenback. We will be left with some of the lowest interest rates around and mediocre fundamentals at best. Till next week, have a wonderful weekend. Take care.